a lot of volatility that's going to happen over these next, I don't know, could be 12 months, 24 months, could be 36 months. I don't know. But during that time frame, is this a lucrative opportunity for growth for you? Hey everyone, TDR back here in Miami for this year's Benzinga Cannabis Conference. Next guest joining us is Travis Goad, who's the managing partner of Pelorus Equity Group. Been on a few times. Good to see you. How are things?
Things are great. Thanks for having me on.
Well, it's good to hear that some people are feeling like it's great, but man, the damage has been done on the public equity side. Stock's down 80%. We've had you guys on in the past trying to educate a lot of investors that are fixated on this industry that there are other opportunities to invest, meaning on the private side. You guys are debt lenders, grown substantially over the last couple of years. But overall, is this a viable time being on the private side for you right now in this space for growth opportunities? Is, that's what's most important for investors that they want to hear?
Yeah, absolutely. We're seeing, the best opportunities, even though it's a choppy market and equities are down. This is an industry that's still growing. It's 27 billion a year in annual sales, and it's projected to go to 40 billion over the next 5 years. So even though there's both some profitability issues on the public guys, as well as some custody and technical issues as to why stocks are trading down, this is a cash flowing industry and it's still growing, and there's a demand for capital. So we're seeing some of the more interesting opportunities to deploy capital. And when I think of how you should get exposure to this space as an investor, being in a more conservative position is better on a new fast-growing industry. I think everybody wanted to be on the equity side at the early stages, and they said, why would I take a debt position with a coupon? I'm looking for 100x yields on these companies going public. And I think what you saw is that's just not what happened. This is an industry that's still finding its footing. It's still maturing. And so we've been deploying capital since 2016 in a conservative debt position, and our investors have significantly outperformed the equity investors. And we've been doing 12 to 15% yields the entire time. And so if you actually invested with us with monthly distributions, that's what I want to be clear to people. We're distributing the cash. Now, about 40% of our investors choose to reinvest. And if you do that, you get monthly compounding on top of that. And so
when you say reinvest, explain how that works.
So the investors can either choose to take a cash dividend, or you can use that cash to rebuy shares and increase your share count. And then you get a distribution next month on an even larger share count. And then if you rebuy, you go. And so a good chunk of our investors reinvest so that you effectively get another, call it 1 to 200 basis points of yield on a compounding basis. So while we're doing headline of, call it 12 to 15, you can get 14 to 17% yields by reinvesting your dividends.
So a lot of people would ask, like, how are you able to produce this? We live in a day and age where it's all about collecting data. So we've touched on this a little bit before, but what kind of data are you collecting to give the returns that you're providing?
So we are unique in the space, and I come from an institutional background. I saw the power of big data and what it can do. I was at a very large hedge fund in New York, and when we came to a new space where data doesn't really exist, we said we have to go out and get data and then be able to turn around and analyze it. So we launched a separate data company in 2020. We have a best-in-class data team, and we're scraping data from about 20 different sources and compiling it into a proprietary database that helps give us an edge on the underwriting and deploying of capital. And so, as with any data,
so that's not really, is that happening elsewhere?
No, I know everybody in the space, and I know nobody's doing what we're doing on the fund management side. And so we're very excited, and data, as it grows, the more data points, the more powerful it gets. And so every month we're scraping this data, and it's starting to yield fantastic insights and results that are assisting us in our underwriting as we think, which markets do we want to be in? As we think about saturation levels on the real estate, one of the things that happened in Canada that was so impactful was there was just a massive misallocation of capital and overbuilding of these cultivation facilities.
You think?
Yes. It was one of the biggest misallocations of capital I've seen in my lifetime.
I've seen it firsthand, some of these facilities that were built that were million square footage, and I'm not kidding you, they're empty now.
Correct. And because it's massive, because you can't sell it. And so when I think about risks to our strategy, I think, what if something similar happened in the US? And so part of this data is helping us understand how many of these facilities exist, what is the right saturation level, how many square feet need to exist for the sizes of these markets today, and where do we think these markets are going to grow into? And when you're thinking about the valuation of real estate, that's one of the critical components. And so
what happens, we've talked about how there's a lot of major debt cliffs that are happening with a lot of these, MSOs, and we could see even, I don't want to say one or two, but it wouldn't be surprising to see a top tier MSO company pretty much go defunct. So when those assets become available, are you risk adverse? Like, how do you protect yourself when it comes to something like that if you're lending out money towards specific companies if that were to happen?
So we think about that risk in several ways. One is we lend against the value of the real estate asset
Okay.
rather than the value of the corporate. There's a few other competitors that recently launched in our space, and if you think about lending as a political spectrum, all the way to the right is a pure corporate lending model, all the way to the left is a pure real estate lending model. Everybody in this space, because of how you have to collateralize the licenses, are somewhere in between. And we are as close as you can be to the pure real estate model, and we lend only against the value of the real estate, where some of our other competitors have lent against the value of the company, and they've lent against the value of licenses, accounts receivable, and other things. And so when
Why
you see
wouldn't more companies do that though? That seems like as far as doing the actual real estate value versus the corporate side,
the borrowing companies or the
lending.
the lending, so why wouldn't more companies do that as a lender? Well, we don't think that was a prudent strategy. We thought in a
Right.
new industry with a lot of volatility that you want to be more conservative and lend less because it's just unpredictable what's going to happen. And so to follow on to your question of how we think about risk is the guys that have lent on that corporate lending model are feeling much more pain today because when equities are down, it much more impacts the value of what you lent against.
Yeah.
We lent against the real estate. So as long as
You're
there's still,
protected.
we're in a more protected position. We're not immune from everything, but we're very protected. And then if that company were to, for some reason, not be able to survive, as long as there is a demand to grow and cultivate within that state, a better operator will either absorb them or want to step into this asset and ultimately operate out of it.
And this is the classic example as to how this industry is all legislation on the public equity side right now, because when you look at the amount of states that have legalized cannabis from a medicinal and recreational standpoint, we were here a year ago. Now we're here.
Correct.
Revenue that's being produced. So whether it's private or public, if you do see a public company fold, you're still seeing a lot of dispensaries opening up across the country, correct?
Correct. We're seeing a lot of dispensaries, and that's something we pay attention to. And we look at each market. We say, how many dispensaries do they need? How many square feet do they need in these markets? And we try to figure out if they're over or undersupplied. And that helps inform our decision on where we want to deploy capital. But what we've seen in this space so far, whether it would be a loan in our book or one of our competitors' books, is that right now, there is demand for these real estate assets.
Yeah.
There's not necessarily, if you lent against that corporate value, not necessarily you're going to be made whole on the corporate value, but people are stepping into real estate assets. And I've been having meetings with operators looking to expand, and they would love to step into an existing facility. It reduces your construction timeline risk, your cost to overrun risk. There's a lot of risks that come with building something from the ground up.
Making
So
money quicker.
correct. So if some operator wasn't able to operate profitably out of one facility, it could be how they were set up. Were they vertically integrated? Do they have a brand? Can they protect their
Are you
margins?
finding that with what you're outlining right now? Like a lot of people that say didn't know how to function a business before, smarter people are getting involved.
Yes. I'm having real-time meetings at this very conference about that exact same thing.
Yeah.
Yes.
Yeah.
And what we're seeing is that certain operators, and it may be even one, maybe they were a poor operator. Two, maybe they just weren't set up correctly. So in certain of these markets, and what we're finding as the industry matures, is you really need to be able to control your shelf space, and you need to have a brand. Brands used to, everybody's always thought brands are going to matter, but consumers weren't really identifying much with brands. And what we're starting to find out is some of these brands are starting to find footing. Consumers are seeking out certain brands. And so controlling that protects your margins. And if you can control your shelf space in these dispensaries, it also protects your margins. So some of these guys that maybe were late to controlling that or getting those and had a pure wholesale model may be underperforming, but a buyer who already has dispensaries and doesn't have a pure wholesale model could then operate extremely profitably out of this facility and would like it. And so that's what we're seeing.
It's the maturity of an industry.
Correct.
Learning as you go, right?
Absolutely.
Well, as you said, like the maturity of the actual industry, a lot of volatility that's going to happen over these next, I don't know, could be 12 months, 24 months, could be 36 months. I don't know. But During that time frame, is this a lucrative opportunity for growth for you?
Yeah, it's a great opportunity for growth, and we're seeing attractive deals. We're starting to see operators that have figured out the model that works. As the industry grows, nobody is entirely certain which model is going to prevail, and so what we're starting to see as we mature is that certain models are working, and the operators that have been efficient on the operating expense side, have been prudent on expansion, are doing well, and those guys are looking to take advantage in this dislocation, and we're looking to fund that expansion of these stronger operators, and we want to continue to fund the expansion in new states. So yes, we're seeing fantastic opportunity, and what we're also seeing is because very few people are deploying capital, we're one of the few groups that continues to raise capital and continues to be able to deploy capital. It gives us an opportunity to, one, go up in quality on operators and deal with the best of the best, but then two, command really attractive pricing for our investors in this market on a floating rate basis and get warrants and equity participation, which we think will ultimately yield value down the road.
Yeah. Well, when you look at it, it's all about data, as you said. So it allows you to invest, obviously, lend, I should say, in specific markets that have the biggest growth opportunities, maybe where there's too many, obviously, licenses. So a very calculated approach ultimately gives you a better return for the investors on the fund, correct?
Yes, correct.
Okay. So if I'm looking at this right now, 2 years ago, 3 years ago, if I had $100,000 on the public equity side, stocks are down. Like, I remember being at MJ Biz in the fall of 2021, and I was looking at specific companies that were trading at $30 a share that are now penny stocks. So if you put $100,000 in at those prices, it's like less than $10,000 now. So I want to give an apples to apples comparison. During that time frame, if you were to put, let's say, $100,000 in, what kind of return would you be looking at if you were to do something with your fund?
So if you were to put 100,000 in our fund roughly around the same time, your position would be up about 30%. So you'd be about 130 to 140,000,
Wow.
depending on whether you reinvested your dividends or you didn't.
You know what's crazy is I think everyone would be happy if they still had their same $100,000 from like 3-4 years ago. But that's an eye opener. What's the sentiment like this week for you down here at the conference?
So we're seeing an opportunity. I mean, cannabis is going through a challenging time right now, and we view this as something that's normal for a burgeoning industry. There is going to be some consolidation, we think, in the operator space. We do think certain weaker operators who are struggling to protect margins may no longer be around or may be rolled up. So there is a mix of a sentiment of certain operators actually aren't super upbeat. They're upbeat about the growth of the industry. They're upbeat about revenue growth. They're upbeat about a lot of things. However, capital is challenged in this space. I mean, capital broadly in a macro sense has become harder to come by, whether even in the non-cannabis space. And so cannabis being less liquid, it's feeling that more. So some of these operators are dealing with being forced to become profitable and cut operating expenses and become efficient in a challenged capital environment. And so it's a mix. Now, I'm seeing opportunities. We're seeing even operators in our book and in others, even in these unlimited license states that are hyper competitive. We're still seeing certain operators who become efficient on the expense side outperform and make money. And so we're also seeing some of these markets turn around. I mean, California, for instance, almost all of last year. And the way we look at this is every market new, it's a long upward trend growth line, but there's volatility up and down. There's supply times of oversupply where prices drop dramatically, and then it usually leads into an undersupply where prices go up dramatically. And what we're seeing in California last year,
so you stand to benefit based on the data that you're collecting from that.
Very much so. So we spend a lot of time looking at price data of flower, about how many facilities exist and how we think about which markets we want to be in. But I would tell you, California broadly, last year, greenhouse flower was, call it $400 a pound. Today, that same greenhouse flower is going for $800-900 a pound year to date. So you're talking about a doubling of price because last year was so painful. Some of the weaker guys went under. A lot of people didn't renew their license, and the stronger people that weathered the storm are now benefiting from it because demand is gone. The demand for cannabis is still climbing. Let's be clear. It is not.
The percentage of companies or operators that have not renewed their license in the state of California has been astronomical, right?
Yes, yes. We've been watching a drop. It's almost a 30% drop in a renewal of certainly outdoor licenses, but you can watch the licenses because we track this data on a time series basis, and we're seeing it. The non-renewal Now, there's still a black market, which is obviously we can't track. But what we're seeing is quality wins out, consistently wins. So
100%.
consistency wins out, and brands are starting to win. And so if you can protect your margins, you can still do okay in California. And with these bounce back in prices, we're seeing. Again, if you talk to a lot of people in this market last year, they would have said you'd be crazy to be in California. How would you be there? This is insane. The market's screwed for the next 5 to 10 years. It'll never recover. And we've seen this cycle being in this space since 2016. We've seen this cycle multiple times. Everybody said the same thing in 2019. It was oversupplied, and then 2020 was one of the gangbuster years in all of California. And then it led into an oversupply. And when we knew we've been here we've been doing this longer than anybody else, that it will bounce back, and we think it'll be shorter rather than longer time frame. And what we're seeing is year to date almost a doubling in pricing. And so, and you're starting to see some footing being found in Michigan, which is another going through a short-term period of oversupply. But these are markets that are
Crazy
growing.
what's going on up there.
Yeah. And I will tell you, the demand for cannabis is only going up.
I know.
More people are starting to consume, and more markets are coming online.
I think that's the important thing that investors right now, when they look at this space, I think the thesis has been for the past couple of years, invest in the top 4 or 5 MSOs and let it go away, and everything's going to be just fine. And we will see prices, increase even bigger than what happened in Canada 6-7 years ago. And what a lot of people are frustrated with is that's not happening right now. So it's all about pressing reset, because there's still a lot of interest towards the actual space, but being educated on other opportunities. So
Correct.
When you're sitting down with people in a day and an age where we live in a TikTok world where you got to grab somebody's attention within 7 seconds, they want instant gratification. What's the message that you tell them when it comes to educating about your fund and how it can benefit?
Yeah, I mean, it's really about looking at fundamentals of markets and trying to stay away from day-to-day price action. Getting 200% return in a month or something is not a realistic. I mean, that if that's the kind of stuff that's happening, and don't get me wrong, some of these stocks are very volatile. It's more speculative than looking at the fundamentals, business plans of these companies and providing capital in a targeted way. And that's what we're trying to do, is continue to provide capital to space, target markets that we want, target operators we want, and I wouldn't even say more of like a slow and steady growth rate, but our returns are fantastic relative to other options. And so what I'm saying is, even though our goal is to be disciplined, it's to learn as the market grows. We're learning in a new industry as well, but we're in the mix. We're following it. We're constantly adjusting how we think about risk and where to deploy capital, and just continue to try to do accretive returns for investors. And if you come into our fund, what you think about is, come for the interest distributions. That's what is the most attractive. But we also are layering in warrants and equity sweeteners in a lot of our transactions. And so some of these,
work?
So we get the opportunity to buy into a company at typically around the value of which we lent to them. And those warrants are typically a 5-year warrant. And so the investors have, as the industry grows and some of these companies do very well, the ability to convert at significant upside value.
Right.
And what we try to do is build in for smaller private companies some liquidity mechanisms so that we can exit and produce cash to our investors if we so choose. But think about it as saying, hey, I'm getting a good interest rate. I'm coming into this this company, whether it's early or mid stage, but I have this kind of equity sweetener that if things go very well, we get more, and our investors get paid for the risk they're taking.
And that's
so
fully guaranteed.
What do you mean it's fully guaranteed?
Like as far as getting warrants.
Oh, so we don't get warrants on every single transaction, but again, warrants is an option to buy into a company at a pre-agreed upon price and time frame. And so if the company goes up 10x, hey, you get that benefit. So you're getting some of that equity exposure that investors have wanted in the stocks. So if that upside scenario happens, you get to benefit from it, but you're in a protected interest earning position where you sit on the loans. And so not all of these companies, some of these warrants are going to be worth nothing, right? And so, but the goal is that we're getting that optionality for our investors. You're getting the interest. Some of these might be 10x, some of these are going to be 0, but net, you will get additional yield and exposure to that equity upside while still protecting your
100%.
downside.
Yeah, I was understanding obviously how warrants work, but you're able to negotiate that and provide that option for your investors.
Absolutely. And that's how this industry works. Most real estate lending does not come with equity participation or warrants. That's one of the things unique about this space. And frankly, I just think it's it's an attractive risk return for our investor base.
What's your, you talked about growth markets. Anything in particular as far as any specific market that you're seeing bigger growth than, say, other parts of the country?
Yeah, well, it's any new market that comes online. I mean, Florida right now is, and it depends on how you did the licensing. Florida's a fantastic market. It's a medical only. We think that that's going to go recreational in the short term. So we think that's going to be a fantastic. Oh, it's going to be fantastic. Yeah, it's a good market today, and I think Florida did a very interesting licensing regime to where it's all vertically integrated. You're allowed to have unlimited dispensaries, but you have your cultivation, and so it's really without making. I think they did it in a responsible way that it's been good for investors and good for operators. We like New Jersey a lot. It's a great market. It went rec.
Yeah.
Right now, there's not a ton of operators in that market, so margins are great, and we're looking at every new market as it comes online. So, one day, I don't know when, Texas will eventually go, which will be another fantastic big growth market.
30 million people in that state. A lot of people.
Absolutely.
Times are changing. You're seeing like Kentucky from a medicinal standpoint legal. Like it's
correct.
Utah. It's times have changed. That's for sure.
Correct. It'll be every state over time.
Yeah.
And the question is just a matter of when they go.
Political talk with Rob. But yeah, this has been great. Appreciate the time.
No, thank you for having me.
All right. Thanks, Travis.
Hey everyone, thanks for watching, and if you want to learn more about the emerging industries that we cover, then leave a comment below and let us know who you want us to interview, the questions you want asked, and the information that you want to learn. We want to hear from you. As usual, click on that bell for all notifications to get the latest information, share this video with your network, and don't forget to subscribe to our channel because we would not be here without you. Thanks for watching, everyone.